Welcome everyone, I am absolutely thrilled to have you here for this explainer. Today, we're diving into something truly fascinating, reading the literal language of the market to execute high-probability gold trades. We're going to bridge the gap between classic technical analysis and heavy-hitting institutional data, giving you a complete visual framework. Because honestly, if you've ever stared at a price chart and felt like you're trying to decipher ancient hieroglyphs without a translation guide, you are in exactly the right place. We are going to completely rethink how you view trading charts.
So let's kick things off with a massive myth buster. Why do most candlestick traders actually fail to make money? Well, you know how it goes. People learn a few popular shapes, maybe a hammer or a doji, and suddenly they're seeing them everywhere, right? They spot a hammer, they mash the buy button, and then they're completely baffled when their account starts bleeding. Here is the hard truth we're going to learn today. A pattern without context, it's literally just a shape. The market isn't some geometry test. That exact same hammer shape can be an incredible high-probability trade in one environment, a total coin flip in another, and a massive, deadly trap in a third. Context is the secret ingredient here, and today, we're going to master it.
Okay, let's dive right into this. Here is our learning journey for today. First, the anatomy of a candlestick. Second, the top candlestick patterns. Third, the COT sentiment cheat code. Fourth, support, resistance, and confirmation. And finally, step-by-step trade execution.
Starting right off with Section 1, Anatomy of a Candlestick. Understanding the miniature war.
Okay, fun fact for you, candlestick charts were actually invented way back by an 18th century Japanese race merchant to track market emotions. Incredible, right? Now, I want you to completely stop thinking of these as just boring abstract data points. Instead, think of them as a literal battlefield. And the anatomy brilliantly illustrates exactly what I mean. Think about the solid part. That's called the real body. This shows us the winner. A big green body, buyers absolutely dominated. A big red body, sellers took total control. And those skinny lines, the wicks sticking out, those are the footprints of rejected moves. It's where one army pushed forward only to be violently shoved right back by the other side. To read this story perfectly, you really just need to understand the 4 key prices that make up every single candle, whether you're zooming in on a 5-minute chart or looking at the daily. The open is where the battle kicked off. The high is the absolute furthest advance of the buyers. The low is the furthest advance of the sellers. And then, the close. Listen, the close is the single most important piece of data on the chart. It represents the actual territory held when the truce is declared for that time frame. It's the final verdict of that specific miniature war.
Moving right along to Section 2, the top candlestick patterns, the power tools for gold traders.
Think of individual candles as the letters of the market's alphabet. These highly reliable patterns, they're the actual words that should command our attention. Take one of the absolute most famous patterns out there, the hammer or the bullish pin bar. Check out the specific visual cues here. Notice how it has this super long lower wick, usually at least twice the length of the body itself, and just a tiny little real body sitting near the top. This tells a dramatic story of rejection. It screams that sellers aggressively tried to tank the price, but buyers forcefully rejected it, stepping in hard to drive the price all the way back up to close near the highs. Basically, the decline might just be over. Now, contrast that with this concept, the bearish engulfing. This one is a 2-candle story. We have a smaller green candle, meaning buyers were in control, but then it gets completely swallowed up, just totally engulfed by a massive red body on the very next candle. This isn't just a simple rejection. No, this is a definitive, violent power shift straight to the sellers. The buyers thought they had the momentum, and the sellers just crashed the party and took over the entire battlefield.
Now, what's really interesting about this is the direct contrast in how professional traders actually use these 2 power tools. You cannot treat them the same way. Pin bars are inherently used for what we call fade trades. That's when you're betting against a short-term move when the price slams into key support or resistance zones. And critically, your protective stop goes safely tucked beyond that long wick. Engulfing trades, on the flip side, are all about momentum. You're betting with the newly established power shift, and your stop is placed beyond the massive engulfing candle itself. So 2 different words, 2 entirely different strategies.
All right, Section 3, the COT sentiment cheat code. Context is everything. Okay, so we've got our shapes, but remember what we said earlier? Shapes without context are traps. So enter the Commitments of Traders, or COT report. This is a weekly government report that shows us exactly where the really smart, heavy-hitting institutional money is positioned. Guys, this is the missing aha moment. I need you to literally burn this golden rule into your memory. When the institutional COT sentiment is bearish, you only act on red candles. When it's bullish, you only act on green candles. Seriously, fighting this macro sentiment is the single biggest trap in trading. If you see a gorgeous green hammer, but you're in a heavily bearish COT environment, it's a trap. It's just there to lure in late buyers before the floor completely drops out.
Let's see how this actually plays out in practice with the COT candle confirmation matrix. Let's say the institutional COT bias is bullish, and you spot a beautiful bullish candle pattern right at support. Boom! That is a strong buy. The stars are perfectly aligned. But look what happens if the COT is bullish and you see a bearish candle pattern. It's not a sell, it's a no trade or a fade. You just politely walk away. Conversely, if COT is bearish, you're only hunting for those strong sell signals, completely ignoring all the bullish shapes. See what we're doing? We are aligning our intraday candle patterns perfectly with the macro institutional sentiment.
Which brings us to section 4, support, resistance, and confirmation. Layering the data for high probability. So we have our words and we have our context, but now we need to know exactly where on the page to read them. Professional traders absolutely demand multiple layers of evidence to align before risking a single dime. We call this the triple confirmation screen. Layer 1 is your weekly COT direction, that structural positioning we just talked about. Layer 2 is a volume surge. You have to see a spike in real-time volume, confirming that institutions are actually jumping in as your pattern forms. And layer 3 is the candle pattern itself, reacting precisely at daily support or resistance zones. When all 3 of these layers stack up perfectly, you have absolutely maximized the probability of a winning trade.
And finally, Section 5, Step-by-Step Trade Execution, the Professional Checklist.
Let's move to the execution phase and see how this all builds into a strict, actionable daily routine. We're shifting from theory right into practice here. Step 1 actually happens before the trading week even starts. Determine the weekly COT bias on Friday afternoon. Write it down and literally stick it to your monitor. Step 2. Mark your daily key support and resistance levels every single morning. Those are your battlegrounds for the day. Step 3 is where discipline is absolutely paramount. Wait for the trigger candle to completely close on your 15-minute chart. Guys, do not jump the gun just because a candle kinda looks like a pin bar mid-formation. Wait for the close. And step 4, execute your entry, stop, and target systematically, purely based on the specific rules for that pattern.
As an example, consider 2 classic multi-candle reversal patterns, the morning star, which indicates a bullish reversal, and the shooting star, indicating a bearish reversal. Now let's say you see a picture-perfect shooting star forming right at major resistance. It looks like an absolute textbook short, right? But wait, remember our checklist and our rules? If your step 1 sticky note says the COT is aggressively bullish, that beautiful shooting star is completely useless to you. You ignore it. You never ever take a candle pattern that fights the macro institutional bias. Now before we wrap up, I'm going to give you an ultimate cheat sheet of the absolute best power candles for both reversal and continuation. Snap a mental screenshot of this. Bullish and bearish pin bars show definitive rejection at key levels. Bullish and bearish engulfing candles show violent power shifts. The doji represents extreme market indecision, signaling that a major breakout is imminent. The Marubozu, that massive body with 0 wicks, shows maximum unquestioned conviction, one side completely dominated. And the inside bar represents a coiling spring, just building up kinetic energy for the next massive move. Really focus on mastering just these top patterns paired with your COT data. So the crucial point we're driving home today is summarized perfectly right here. The COT tells you who is in control. The candle tells you what happened. Always trust the who. When you open up a chart tomorrow, please don't just hunt for random shapes. Figure out who the big money is actually backing. Map out the battlegrounds and just wait for the market to speak clearly in the direction of the dominant force. So what do you say? Are you ready to stop guessing and start reading the market fluently? Dive into those charts and see the story unfold for yourself. Thanks so much for joining me on this explainer, and happy learning.